All right, for today, guys, we're going to wrap up our discussion on Chapter 12's capital investment analysis. All of our homework is due today, the 30th, and our next exam will be on Thursday, then May 2nd. It's up to you if you want to come to school to take the exam. That's optional. You can certainly take it at home. So keep that in mind as you're thinking about that choice. I will be here, so if you have questions while you're taking your exam at home, just give me an email shout on your question. That then leads to our last chapter, which is going to be Chapter 15, and this is only a 2-day discussion, 2 class periods, and then our final exam, which has to be completed by the 14th. Like our exams, I will open it up on May 9th. If you'd like to take it earlier than May 14th, that's certainly acceptable as well. So just let me know what your plans are regarding the final 2 exams. Sydney?
Okay, the last one can we take at home or do we have to take that?
No, that you can take home as well. So just let me know if you are thinking of doing it early, just so that I have it opened up for you. All right, so today is basically a review day, so to speak, covering all the basically 4 computations involved with capital investment analysis. So the problem I picked to start our class today is problem 37. It begins on page 685. We're going back to what we started with, which was the payback method, a very simple computation used by many non-accountants to analyze whether to accept a project or proceed with a capital investment in a project or not. So here we're looking at Cambry is looking at a investment. She's looking at an investment of $20,000. And she has 2 choices, either take project A or project B. And our first requirement in the cash flows are uneven. So this makes the payback computation a little more complex, but hopefully it won't be too bad. So let's start with project A. I do lay it out as the book shows, where I have my unreturned investment on the left, my cash flows next to it. In year 1, it's $6,000. I'm on page 686 now. Obviously, 6 does not recover the 20, so in payback terms, that 1 year has passed. Then I go to year 2. What do I have left? I have $14,000 left to recover out of the 20. And year 2's cash flow is $8,000. So here again, the cash flow is not adequate to pay the full investment back yet. So we're going to take another year. And then finally, our third final, which does recover it. I have what left? $6,000 left after the 8 is subtracted. And in the third year, I do recover the amount. But in this case, I only need a partial year to recover the $6,000 left, and that comes out to be 0.6. So 2.6 years is the payback. And how did I get the 0.6? I had $6,000 left to pay back. My cash flow in year 3 was 10, and that gives me my 60%, or 6/10 of a year, and then I should have that paid back. So this will be on the test where you'll have this uneven cash flow and then figure out that payback period using this, I think, pretty simple template. If you noticed on project B, It's the same cash flow in the first 3 periods or first 3 years. So the answer is the same. So using this analysis, we basically cannot determine which project we should take. Either one would be adequate using payback as the model. Any questions on payback computation? Anybody at home have any questions? Are you okay? Okay, thanks guys. Let me know. All right. Also with letter A, and let's just look at this. I have here compute the project A accounting rate of return. Which is really number 2's question under the required accounting rate of return. We first have to compute the depreciation. Straight line method. We have our cost minus our salvage value, which was 0 in this case. They didn't give us any. And the term or life of this asset is 5 years. So that would generate $4,000 per year of depreciation expense. So when I get to the accounting rate of return, that's usually the first thing I accomplish is that expense amount. After that, the book then has us subtract the $4,000 off of each cash flow. But I think it's easier if we just simply take an average of the cash flows and we do that by taking the totals 6, 8, 10, 10, 10. So these are the cash flows. I'm going to add them together and get an average. Divide that by 5 because we want the average cash flow. And sure, does anybody have that amount?
I got 8,800.
8,800. So that's the average. But remember, with the accounting rate of return, we've got to convert this cash flow to a net income profit number. So I'm going to subtract the $4,000 of depreciation expense. This is the only model that uses depreciation expense, is the accounting rate of return. So I subtract that 4 off. I'm left with 4,800 of basically profit, right? Average profit. And that's what I divide by the $20,000 investment. So my accounting rate of return then is, Carla, how much? Average profit over 20. .24? Awesome. Thank you. So 0.24, or in many cases it is a percentage, 24% accounting rate of return. So very good. Anything over 10 is pretty good. For project B, we do the same thing. We have the same investment of $2,000, so our depreciation entry, the step 1 is already finished for us for part B, for project B. All we got to do then is take the average cash flow. So we're going to jump right to step 2 here. The average cash flow across 5 years is going to be 6, 8, 10. And then 3, 3, 3. We divide that by 5. I think it's 6,000, is that right? Eric, do you have that a number? Yeah, that's what I thought. Good, thank you. The average cash flow is 6,000. I subtract off the depreciation of 4. This is my expense. To get my profit of 2,000. And I divide that by my $20,000 investment. And that looks like it's only 10%. So for project B, 10% is my accounting rate of return. So obviously, looking at the 2 accounting rate of returns, which one should I do? I got 24 versus 10. I would do the 24. Right? So for mutually exclusive projects, which this is, we only have $20,000. We have to pick one. So this project A gives us the best choice. So on the test, if I give you the expense, this depreciation expense number on a problem, do I use it for any other model? Net present value, do I use it? The answer is no. Do I use it for internal rate of return? The answer is no. Do I use the depreciation expense for payback? And the answer is no. So don't get tricked. If I give you more information on a problem, don't think you have to use all of it. So be careful. Guys at home, okay with accounting rate of return? Okay, awesome. Thank you, guys. Let's go to part, or letter B then. Wilma is retiring and has an option to take a retirement as a lump sum of $450 or to receive $30,000 per year for 20 years. Wilma's required rate of return is 6%. This is a net present value problem. Net present value problem. We're going to compare the 450 to the cash flows coming in. So what is the present value of an annuity? An annuity is an amount that we get every year for, in this case, 20 years. So I'm going to get this $30,000 amount for 20-year periods. This requires, or she wants, in order to do a net present value, we have to know the required rate of return. You can't do a net present value without it. So I'm going to take the 30,000 and I'm going to multiply it by the discount factor. In your book, which table do I use for the discount factor? The present value of $1 or a single amount or present value of an annuity? What page? I want the annuity one, right? So what page is that on?
671.
Yeah, 671. Thank you, Sandy. Yep. So go to page 671. That's our annuity table. Sandy, what is my discount factor? Using the table. $11.46992. Perfect. That's exactly right. Awesome. So I'm going to take this, multiply it out, and what do I get, Sandy? What is my present value? Yeah, that's exactly what I got. $344, $97.60. So guys, what would you do? Would you take this annuity stream, or would you take the lump sum? Obviously, you would take the lump sum, right? So the best choice is to take the $450,000 lump sum rather than the annuity. And that's what most people do. They take the lump sum. And then sometimes they're broke in a couple years. But that's the way it goes. All right. C. David's looking at a new investment. The equipment costs $30,000. He estimates that he'll gain $9,000 per year for 6 years. The required rate of return I gotta find out where David is. Oh, here, number 4. The return is 8%. We're looking for an 8% return. So here again in year 0, I'm spending $30,000. So that's an outflow. In years 1 through 6, I'm getting $9,000 per year. So I'm going to discount that with my discount factor, which again, what is the 9,000? Is it one amount or a series of amounts of 9? So that would be an annuity. So again, we got to go back to page 671. Find the discount factor. Carla, do you know what that is? It's 8%, 6 years. Yes, that's what I got, 4.62288. Very good. So that's my discount factor. So I'm just going to move this over, just so I have enough room here. So I'm spending 30 in the hopes of getting 9,000 for the next 6 years. I'm going to multiply it by the discount factor of 4.62288. I get 41,605.92 cents. I'm just going to make that a whole number, 41,606. It is positive of 11,606. So if this value is a positive value, positive net present value, we would accept the project. I'm getting my return on investment. I'm making the 8% return on the investment plus a little bit more than the 8%. If this is positive, please note for the test, that must mean the internal rate of return is greater than the 8%. If this number is positive, my internal rate of return is greater than the company's required rate of return, in this case 8%. Obviously, if it's negative, the internal rate of return is less than the 8%. Those are those multiple choice questions that sometimes we struggle with. How to correlate this net present value with the internal rate of return. How do they work together? So please know that. Our final computation then is computing an internal rate of return. She's looking at an investment of $400,000 in this equipment. The cash flow from this investment is, see, savings of 75 per year. What I'm doing now with this division is I'm computing the discount factor. Olivia, what's my discount factor here if I divide these two numbers? Okay. What table do we look at then to get the interest rate? It's a annuity.
Oh, I'm sorry, you guys.
Yeah, just
I'm
go
sorry.
ahead. Keep going.
Now we're looking at
I think we're on, how many years? I think it's 10 years. So you got to be on row 10.
the 8%.
5.33,
Never mind. I was
row 10.
7.72173.
No. I have the discount factor already. I need to find the interest rate. I think it's between 12% and 14.
I'm not gonna lie, I'm kind of lost.
Okay. What I want you to do, Olivia, is go on row 10
Okay.
and look for this number or something close to it.
Oh, okay.
We're trying to figure out the internal rate of return. Somewhere around there.
Okay.
Now, it's not perfect, so we'll take our calculator shortly, but I want to answer the question. The company's desired rate of return for cost of capital, to answer the last question, company's cost of capital is, in the paragraph, it's 8%. So knowing that the internal rate of return is between 12 and 14, should we take the project on? Eric, should I take the project? Actually, yes, we should. If my internal rate of return of between 12 and 14 is greater than the company's 8% required or cost of capital, I should accept this project. Does that make sense? Yeah, okay, sounds good. Yeah, if it was below the 8%, if the internal rate of return was below the 8%, then yeah, we would reject it. So let's try our calculator to see if it is correct. So if you have your financial calculator, pull it out, please.
I remembered it today.
Yay, Allison. Good deal. Let's put our numbers in. Our investment, so again, I'm looking at the middle numbers here. CF for cash flow, NPV for net present value, and then internal rate of return. Those three buttons. But we got to put our cash flow in first. Remember to clear it out to zeros. Use second function, clear work on the bottom. My initial investment is $400,000. Put a negative in. That's one thing students forget on the test, is to put that negative for the investment. That's the cash flow going out. Hit the enter key. Once we have the cash flow out, the cash flow coming in is $75,000 positive. Enter that. Once that's entered, down arrow again, you should hit the letter F01. It defaults to 1, but this was for 10 years, right? Row 10 is what we were looking at. So 10 years is what F1 will be. For 10 periods of time, I'm going to get the 75,000. And that's all we have to do, right? That's all we have to do to compute internal rate of return. Go to IRR and hit compute. So the calculator answer for internal rate of return was 13.3? 43%. Either answer is acceptable. Obviously, CNOW will be looking for a whole interest rate, 12, 14. So if you do use your calculator answers for the test, CNOW is going to mark them wrong. I will come through and correct those incorrect errors. Let's do the net present value since we got the numbers in. The company's desired rate of return was what percent? The 8. So put the 8 in for the interest rate. Put the 8 in for the interest rate here. And then just enter that. Down arrow. Is the net present value going to be a positive number or a negative? It should be positive, right? Because my internal rate of return is greater than the 8%. So if I hit compute here for net present value, I get a positive $103,000. So this clearly shows that this project is a very good one, a very profitable one that returns my investment, clearly makes 13% on my investment, plus this $103,000 extra cash flow for my company. It's creating wealth, right? So on the test, which measurement do we use for mutually exclusive determination? It's the net present value. Even though internal rate of return is the most commonly used measure, if I got two competing projects under a mutually exclusive scenario, net present value is the one we need to use to pick our project. On the test, you'll be asked, do I pick project A? Do I pick project B? Do I pick A and B? Do I pick neither? That's A, B, C, D. If it's mutually exclusive, it's the one that gives us the highest net present value is the one you pick. Even though both are positive, it's the highest number. Guys at home, what do you think? Clear as mud? All right, good job, guys. Does everybody understand this net present value thing? Why we use it for mutually exclusive? I'm hoping so. All right, there is some terminology on pages, let's see, I'm at the computation here. This is in the appendix. The appendix. There's a difference between discount rate is the interest rate basically. Discount factor, that's what's in our tables, our present value tables. So that's those numbers, 4.3352 or whatever that is. That's a discount factor. So just know that terminology. You can see that here where on this, the table gives us our discount factor for each year, right? Year 1, 2, 3, based on an interest rate that we want to earn on our investment. So just a review of that. Annuity is that flow of money that's even, right? So much per year. So what this is trying to show here is basically we have $100. It's the same number. I can use the present value of $1 table, but I got to do it 3 times, right? So there is an easier way by just lumping or using the other table which is the annuity table, and then I only have to do it once, times that discount factor, and just do it once and get the same answer. So that's all what we're trying to wrap it up here with. Let's just know the difference between the two tables. One's the present value, one is the present value of an annuity. Okay, I do want to do one of these, and I want to practice. Let's just do the first one. Before break here. So this is problem 35. Exercise 35. We have a company looking at two different alternatives. Puro has a piece of equipment, and then Briggs has the other. We're trying to determine which one is our best choice. And in this case, the cash flows are uneven. So what I've done is I've laid these out in a table for each year, and then we can multiply the cash flow by the discount factor to get its present value. Now in year 0, there is no discount. I'm simply spending $560,000 on that piece of equipment. Since we have uneven cash flows, we can only use one table, and that's the present value of a single amount on page 670. So now my table changes from an annuity to one that's per year. And for problem 35, the company rate is, what does it say? Anybody at home? Yeah, it's the 12%. Thank you, Sandy. We're also going to do this on the calculator when we're ready. So using 12%, go down that column. Oops. I'm just going to write these down. And if someone can verify this, hopefully I got the numbers right. This is another nice thing. If we do it on our calculator, we can really double check our work here. Because it's pretty easy to make a typo error. So I'm going to multiply these out then. I'm not going to put the cents down, I'm just going to put the dollar amount. So in year 1, that value of 320,000 is really only worth, in today's dollars, 285. And we can continue on with the rest. Year 2's cash flow of 280 is valued at 223. 213. $240 times 0.71178, 170, 827. $160 times 0.63552. I'm down to 101. 683. And then our final one is 120 times 0.56743. I'm down to $68,092. So it certainly looks like I have a positive net present value. Someone verify this? I suppose we can use our calculator. I have a positive 289,530. 289,530. Does that sound right, guys? Anybody at home keep up? Or should we use our calculator? Okay, thank you, Carla. Awesome. So let's use our calculator. Let's see if we can get this to work the same way. So again, hit on the CF button first. Make sure you clear it out. Second function, clear work. 560 is entered first with a negative. 560 negative. Enter. You should see a little like arrow that shows that it's been entered right above the number. Down arrow. Cash flow 1 is 320,000. Enter that. Cash flow 1, 320. Cash flow 2, F1 is 1. Cash flow 2 is 280. Enter that. That 2 is also for 1 year. So F2 should be 1 automatically. Cash flow 3 is 240. Enter that. Again for 1 year. F3 should be 1. Cash flow 4 is 160. Enter that for 1 year. So F4 should be 1. And cash flow 5 is 120. Enter that. And again, F5 should be 1 year. So a lot of things, a lot of numbers to key in. So the net present value then, oops. Yeah, Sandy? Cash flow 2 is this year 2 amount, 280,000. So if I down arrow to cash flow 2, it should be 280, which is this number here, the second year. Cash flow 3 should be 240. Okay, you see it in the book? I'm hoping that's in the book. It's the second year. Yep, second year. So 320, 280, 240, 160, 120. The interest rate that's desired is 12. So enter the 12% for interest, down arrow. You should get NPV and then hit compute. You should be at 289,530, and that's exactly what the calculator came up with. 289,530. Oh, okay. Are you okay now? All right, good. So you should get a net present value of 289,530. The internal rate of return is 35%, 35.4%. So I'm just going to put that down too. Just so if you want to practice later, you certainly can. So using this cash flow, we're generating 35.4%. I think that's what I got, yep. Which is clearly over the 12. Remember, this is the 12% column. So you certainly would accept the project. And that's what a positive net present value is. You would certainly accept this project. How did the calculator go, guys? At home. Okay, thanks, Carla. All right. Sandy, if you need to, you can always review the video later. Eric, you're all right? Okay, good. Awesome. I will have notes on this Briggs cash flow. I'll just post them for later. In case you do want to practice another one of these, you certainly can. On problem 41, let's just jump to there. I just want to make a note of how I have this laid out. This particular problem, we're looking to spend in year one 1.2 million on some investment. Obviously, that's a discount factor of 1. But I have another line here in year 0 for working capital of 120. So we're also spending that amount of money as well in year 0. So we actually have two amounts that we're spending, the initial cost plus the working capital. At that point in years 1 through 7, they have a positive revenue of 400, but they're spending 270. Remember, there's always expenses with revenue. So my net cash flow is 130. So that's what I want to use here, is the 130 for 7 years. That's how we're getting to that number. My revenue of 400 minus the 270. Again, the author doesn't combine these two together. They're doing it separately. In addition, in year 5, they do a refurbish, major overhaul at 120. So that's another negative. And then finally in year 7, I recover the working capital. 520. So that is a positive. And I'm recovering the 96,000 sold in the last year. So these are two pluses that help at the end. So obviously you would take these amounts now and discount them back to present day dollars. And the answer is a huge negative net present value because there's simply not enough cash flow to warrant the 1.32 million that you're investing here. This problem too, I will have laid out. I will have an answer key for you if you wish to review it. You certainly can. You can also use, this is another good one for practice if you wish to on your calculator to see how it comes out. So just keep that in mind. If you're using the calculator, guys, you will have to lay it out by year. So year 1, year 2, year 3, do it individually so that it computes it correctly on your calculator. You really can't use the layout that I have here to do a calculator choice or an option. Okay, there's one more just like 41. I'll look for that answer key as well. So let's take our first break here. We'll stop here and we'll do our blueprint problems at the end. All right, our last problem, or two problems actually, that we'll cover are these overview problems, blueprint problems for Chapter 12. These are not in the book, obviously. So let's take a look at our first scenario here. We have this person looking at a new piece of equipment. It has a $3.2 million salvage value of $400. Life expectancy is 5 years. In addition to the cost that we're spending for the equipment, we're also looking at an additional cost of $400,000 in year 0, along with that amount to be recovered in the last or 5th year. We're looking at a net cash flow which means revenues minus the expenses of $1.2 million per year over these 5 years. So when you're setting up your net present value computation, make sure that the cash flow is net cash flow. And that means revenue minus the expenses. The other item presented here is 12% is the company's desired rate of return. Company's desired rate of return. So the problem is laid out where they want the cash flow first by period. So here we're looking at the equipment costing $3.2 million. Working capital costing $400,000. So I am spending that money in year 0. Obviously in year 0 the total is $3,600,000. That's what I'm spending on this project. They do a nice job presenting the net cash flow. Revenues of $3 minus the $1.8 million. So I'm going to put this in a different color. $3 million of revenue. $1.8 million of expenses, net of $1.2 million across 5 years. well, actually 4. Because in year 4, I'll put this in green, I have again the 3 million, the 1.8 million negative, and then I'm going to recover the salvage value, which in this case was 400,000, and recover the working capital of 400,000. Which then gives me a positive cash flow of 2 million. To end it out. So I'm spending 3.6 in year 0. I'm getting 1.2 million for 4 years, and in the 5th year I'm getting that 2 million amount. So at this point then, in part 2 of this problem, I can discount everything, starting with the cash going out, which is 3.6 million. Negative. The discount factor in year 0 is always 1. My present value, 3.6 million. After that, in periods 1, 2, 3, and 4, I'm receiving a net cash flow of 1.2 million. So I'm just going to put 1.2 in 4 times. Go to page 2. And then in period 5, I'm going to get that bigger amount, $2 million. So again, I go to my table. Since they're different amounts, uneven amounts, I should say, we got to use table 1. So going back to page 1, the discount factor is using a 12% return. 0.89286, 0.79719. So those are my discount factors. Years 1 and 2. Year 3, 0.71178, 0.63552, 0.56743 to round it out. Here again, much easier to do it on the calculator, but let's see what we get. Starting with the year 1 amount, 1,200,000 times 0.89286, and just round it to the nearest dollar. We get 1,071,432. Year 2 at 1.2 is only worth 960,628. 956,628. Year 3, it's only worth 854,136. Year 4, 762, 624. And finally, year 5. $1,134,860. We combine the negative with the positives to get the net present values. So if I go back here, starting with my blue number, 3,600,000 negative, I'm going to add all the positives. This is good. I got a positive 1,179,680. Anybody at home verify that? Or here? That look okay? Thank you, Carla. Awesome. We can certainly use our calculator too. So our net present value is 1,179,680. So the word net means net of the cost, right? The initial cost. That's what our positive present value is. So since it's a positive number, right, we would be accepting the project. Because it's a positive net present value. Whew. All right. Any questions on the difference between cash flow and, this is cash flow, which doesn't have any discounting on it, versus present value, which does have the discount. So you might be asked just for the cash flow, not so much the present value. So look for both terminologies on the exam. Sandy, Eric, you're all right over there? Okay, thank you. All right, here's our last problem. Scenario 2, a firm with a cost of capital of 10% is considering a new CAD system, $360,000, and they're expecting net cash flows of $149,850. Here's that terminology again, the discount factor associated with this project, round to 3 decimal places. Sometimes students want to put internal rate of return here. All we're looking for is the discount factor. The DF is equal to the investment divided by the even cash flow. This only works if the cash flows are even, and we do have that situation here. So our $360,000 investment of this CAD system, we're expecting a $149,850 cash flow, net cash flow, right? So revenue minus expenses. My DF is how much? It's got to be 2 something.
I got 2.4.
2.4. Does it come out even to 2.4?
Oh, no. 2.4024024.
So it's, I think rounded to 3 would be to 402? Okay. So that gives us our discount factor. Now we can look it up. What row do I look for? What row am I on? Carla, what row do I look for this 2.402? Excellent. Yep, row 3. And why is it row 3? Because we're expecting this cash flow for 3 years. So this is going to be row 3. So using row 3, we run across the annuity until we hit 2.4. And it looks like, what's my internal rate of return? Yep, 12. That's the closest interest rate. Yep. 12 is my internal rate of return. And again, you can use your calculator, throw that in. Throw the 360 as a negative number in year 0, 149,850 in cash flow 1 for 3 years. Letter F is 3 years. And it should get you pretty close to that 12% internal rate of return. So, are we going to accept this project? So I'm trying to answer this question here. Should we accept or reject? What's the cost of capital? 10%. The internal rate of return is 12. So accept it, right? Because the internal rate of return is greater than the required rate of return of 10%. The 12% is greater than the required rate of return of 10. You will be asked that question a lot on Thursday as to whether you accept a project or reject a project. Any questions at home on that? Acceptance or rejection? Okay, perfect. What I want to end our class discussion with is, I'm not sure where you guys are at on problem 45. We have talked about this. Are there any questions regarding 1245 that you can ask right now? Probably the biggest obstacle on this question is, don't forget that for each cash flow, for each year, there's a $3,000 expense that has to be reducing that revenue stream of 19.8, the 27, the 32.4s. You have to reduce that first. Even when you're doing the payback, even when you're doing the accounting rate of return, that 3,000 has to come out of there. So please don't forget that. And the other problem is for the net present value, item 3 here, for the net present value and the internal rate of return computations only, don't forget the salvage value. Please add that in period 4. Don't forget the $6,000 salvage value amount that's added in that cash flow stream in period 4. So please remember that. One more thing that I don't have listed here, guys, is for question number 4, for question 4, the expected cash flow is going to be reduced by 1/3. I think we talked about this, but so as an example, for period year 1, my revenue, so this is year 1, my revenue is $19,800. I subtract the $3,000 of expenses. My net cash flow is $16,800. I take 2/3 of that amount, which is a 1/3 reduction, and my new cash flow for year 1 is 2/3 of 16,800, which is $11,200. So what happens here, or what we're trying to determine, is based on this reduction in cash flow, does it still pay to buy this piece of equipment for $74,000? So it gives probably a more realistic view in some cases as to what they're going to benefit from this new product. So that's what you got to determine. And all they're looking for in part 4 is the net present value amount. So it's a one answer question in C now, but it does take some effort to get that reformulated based on the new cash flow stream. Remember, in year 4, the salvage value of $6,000 is not reduced, which makes sense. You still get the same amount of money at the end in period 4. Just the cash flow is reduced by 1/3. All right. Any questions at home regarding the problem 45? Okay. Good deal. That's all I have for today, guys. In fact, if you want to take your exam before Thursday, I'll open it up tonight. When do I do that? So if you have more time tomorrow than Thursday to take your exam, it will be available starting at, well, I'll just start at midnight tonight. So anytime tomorrow, Wednesday, or Thursday, you should be able to take your exam. All right? I'm going to stop my recording. Thanks, guys, and have a great day.